Well, we've been investing very heavily, particularly into EVs over the last several years with a battery platform that is helping us to lead as well.
Because there's a lot of folks that are out there that think it's worth less than $100, and then you have those who are very positive on Tesla. Where do you think it's headed and why?
Look, I think it's going to go up. And what people need to understand is Tesla has four core advantages.
We think the company has, a significant cost advantage versus a lot of their peers, particularly Western OEMs, and certainly has worked through a lot of the ramp challenges that a lot of those Western OEMs are working through right now.
All that and more, so let's get to it. Tesla stock is up right now, but as you can see, the volatility for the day has been incredible. Over the past 48 hours, Tesla has been on a pretty nice tear. But looking at the chart, it appears the stock seems to have run out of steam. But what the do I know? I'm losing money left and right. Over the past week, Tesla stock is still down a little over 3%. For the month, down almost 10%. But when you look at the year-to-date chart, Tesla is still up 95%. Not bad, if you ask me. Now, I took the bear bait. I went heavy on the calls this morning, hoping to ride the potential NVIDIA wave that will happen after their earnings. Now, the only guarantees on this plane of existence are death and taxes, so I stand to lose a pretty penny. But what's life without a little risk?
I'm now to bring in a very special guest. Paul Jacobson is with us, CFO of General Motors. This is today's 360 Spotlight. So glad you are with us. So 4 straight quarters of higher retail market share in the United States. I'd like to hear what's working. What do consumers want and how are you meeting that?
Well, first of all, Nicole, good morning. It's a pleasure to be with you. Thanks for having us on today. So when you look at General Motors and you look at the quality of the products that we have and the amazing customer response that we've seen really over the last few years with a lot of our new model SUVs and new model midsize trucks, customers just can't get them fast enough. And that's been great for the business. We've continued to perform well, both on average transaction price as well as consumer demand. That's driven us to raise our full year guidance twice this year already, both on the EBIT line, EPS line, and also on free cash flow. So things are going really, really well.
Look, I'm a Tesla bull. I think Elon Musk and crew is running circles around the legacy automotive companies. But that doesn't mean I don't want Ford and GM to succeed. As a US taxpayer, it is in my best interest that they will not need any further assistance in this transition to battery electric vehicles. But in my amateur opinion, both Ford and GM are caught between a rock and a hard place. I do not envy any of the C-suite individuals of either of these companies. So while they're talking the talk, I damn sure hope they're walking the walk, because I will adamantly protest any bailouts for these automotive companies. Ford, GM, get your together.
General Motors with such an incredible footprint, but there's no doubt there is stiff competition here at home and abroad. In China, for example, we're seeing BYD taking huge market share, Tesla and all the other names abroad. How do you battle it out abroad, and what do you see as the China picture for the company?
I'm listening.
Well, we've been investing very heavily, particularly into EVs over the last several years with a battery platform that is helping us to lead as well. We've started to ramp up production pretty quickly. We produced 50,000 EVs in the first half of the year. We're expecting to deliver 100,000 and produce 100,000 in the second half of this year, up to 1 million EVs in 2025, all based on that Ultium platform. So as we continue to ramp up production with new electric products like the Chevrolet Blazer, as well as the Silverado EV. And then we revealed just last week the new Escalade IQ, which will be available next year as a full EV version of the highly successful Cadillac Escalade. We've got a great product suite that's coming to America. We're doing some imports and also some EVs in China. And we're really starting to leg into that and expect those to drive to low to mid single digits margin profitability in 2025. So we've got our work cut out for us, but certainly we feel really good with the products that are coming to market.
I like what I'm hearing. Producing more EVs is the key to making sure that you're able to produce these things profitably. The more volume you produce, the better you should be at producing them. That'll be the key metric I take from anybody trying to scale up to mass production of the battery electric vehicle. Are their costs coming down? When are they aiming for profitability? What do those margins look like?
Without a doubt. In the meantime, you do have looming the UAW risk. I mean, you have votes coming up. This is now going to really come front and center on September 15th. How many days supply do you have ready to go? How much do you need?
Yeah, so our supply has been pretty steady for the last year and a half. You know, we went through the both COVID and then obviously the semiconductor crisis in 21 and 22, and we've managed to keep our inventories at a stable level. But you know, we're in conversations with the UAW, and we're continuing to work through that. Our hope is that we'll be able to come to an agreement with them that rewards our people for the tremendous effort and the amazing quality that they bring to the table for our customers.
Yeah, I mean, I saw multiple reports. I saw more than 50 days. You need 50 to 60 days. That you had 54 days. I saw another one. You only have 36 days. Is there any way to quantify how many days you're ready for? Because the last strike was about 40 days. And one of the reports said you only have 36 days of inventories. And these feel like speculation to a certain extent, because I'm not sure they're in the GM warehouses, you know, and factories.
Right. Let me put it this way. They can't afford 1 day of strike. Pay these people what they're asking for. Give them the assurances that the transition to EVs will not leave them penniless or homeless. And then get to work immediately on training these individuals to transition to the battery electric vehicle space. Time is of the essence.
So we've generally said that we want to keep between 50 and 60 days of inventory. We've been operating in that range, like I said, for the last several quarters, and I expect us to continue to be there. A lot of our vehicles aren't at dealers, so you don't necessarily see them in the dealer lots because they're in the logistics pipeline on their way to dealers. We've had some issues with logistics that we've talked about before, but that means there's more inventory on the ground and in transit to those dealers. So we feel good about what our inventory position is. Ultimately, the best outcome and the best scenario for everybody is obviously to find a way to come to an agreement before that time so that a strike isn't necessary.
And I watched one of your past interviews where you talked about what customers want, and they're looking for some high-end packages as well. There are those who were looking for the Chevy Silverado. They wanted high-end Denali Ultimate package. When you talk about what customers want, what are you having to get out pretty fast these days, as you also are working on a $2 billion cost reduction program?
Yeah, so I would say that the customer response to our higher trim levels has been quite strong. In fact, last year, our GMC Denali product, which is the premium product in the GMC line, we actually, based on consumer demand, created an even higher, which was the Denali Ultimate. And we've seen customer response to that be quite strong. And I think about 70% of our full-size trucks and SUVs are coming in at higher trim levels, which is contributing to some of the margin strength that we've seen going forward.
On the surface, the margins that the legacy automotive companies are receiving from their higher trim internal combustion engine sales looks good. On paper is good. But I tell you, that is a optical illusion. Focusing on quick gains now will lead you to the poorhouse later. I know one thing, they better be using that excess margin to transition to battery electric vehicles. I don't want to hear about a bailout later.
So what we've also tried to do is make sure that we're protecting the bottom line the best we can by reducing our fixed costs. We announced a $2 billion cost reduction strategy to get our fixed costs out of the business and help get us to where we need to be on the EV profitability spectrum as we continue to work through that transition through 2035. And then we had so much success in the early stages of that we just announced another $1 billion on top of that to be completed by the end of 2024. So we've seen the organization rally behind that, making sure that we're leaner, more efficient, the absolute best that we can be. And where we put costs in, we put them into customer features that we know they're willing to pay for, that leads to a better experience for them.
Yeah, that's pretty unbelievable. So cutting the costs, getting out what people need. I did have two quick questions, not the best questions, but in that Berkshire Hathaway cut their stake pretty much in half from 40 million shares to 22 million shares, trimming that investment. I wanted to know if you had any thoughts there. Also, just the recent news with the cruise and the investigation, the DMV investigation there, and having to reduce some of the autonomous driving robo-taxi units because of a recent crash with an emergency vehicle. Do you have a quick thought on each of those?
Yeah, sure, Nicole. Let me start with the second one, because Cruise is obviously a great asset of GM Enterprise, and the work that they're doing with autonomous driving is really leading that industry. We are absolutely committed to safety, first and foremost, above all else, and the teams are working with the California DMV to make sure that we do the thorough investigation, and we make sure that we're guiding with safety at the heart of everything that we do. So we agreed to voluntarily take down the fleet for the short run as we continue to work through those. But we feel good about the trajectory that Cruise is on. The data that they've seen is really, really strong performance safety-wise across the board. But every time an incident happens, we need to make sure that we're on top of it, and the team is doing a good job of that.
Both of these companies are out there operating, getting taxi fares with driverless vehicles. It's quite an amazing thing, but there's a reason why Tesla is still in its beta form. Many would argue, and I would agree, that Tesla's FSD beta has a greater capability than Waymo or Cruise. Hell, put them together. Tesla has more autonomous miles driven and more real-world data for their neural nets to process. Even though Tesla more than likely has greater capability, the cars still need to be supervised by a human at all times. That is what you would call absolute safety. Could you imagine if Tesla was in the same position? This is the first time I'm hearing of this. But if it was Tesla's FSD, it would be on every news network about how unsafe this technology is.
You know, on the stock price, we talk to shareholders all the time. I can't comment specifically on Berkshire Hathaway's decision, but you know, we're absolutely committed to driving shareholder value over the long term. And when you look at the plan that we've got, the way the company is performing, both on margins as well as top line revenue growth, we think we've got a recipe for success going forward for all of our shareholders.
GM saying all the right things, but they better have their shit together. No f***ing bailouts.
Shift our focus now to Tesla and the EV space. Joining me right now, Steve Westley, founder, managing partner, the Westley Group. Steve Westley, I'm so glad you're here with us. I want to talk all about all the EVs that we're watching so closely. Of course, you're a former board member of Tesla. And once again, we saw Tesla cutting prices. I mean, I've heard Elon Musk say they can cut when they need to, but it seems that they're cutting periodically. What do you think is behind that, and where does it fit into the EV space?
Well, you bet. This is extraordinary news. Tesla has just done their sixth price decrease of the year. They're triggering a global price war. And why not? They're uniquely positioned to win the price war because they've got 13% net margins versus Toyota at 7, Ford at 2. No one else can keep up. They're doing a global land grab because they can. And I think what's interesting for investors is this is just terrible news for Toyota, GM, Ford, and the others, but it's great news for consumers. EV costs are coming down a lot, and they're soon, probably by late next year, 2025, going to cost less than gas cars. The whole world is going electric.
Ding, 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 ding. Tell them what each one, Johnny. Your motherfucking right. Industry leading margins allow Tesla to do what no other auto manufacturer is even thinking about doing, and that's lowering the price so that they're more affordable for consumers. Does this cut into the margin? Of course it does, but it's industry leading margins, and they're still making money hand over fist. Strategy is not about what you're going to do, it's about what you won't do. And what Tesla won't do is let these cars pile up or lower their production in the slightest. They're going to drop their prices to keep the production moving. The more butts in seats now, Tesla will reap the benefits with return customers and software as a service. Put the butts in seats. While everybody else is worried about going bankrupt to try to keep up with you, the consumer is going to go with the best product, dollar for dollar. And you know, it'll be Tesla.
Right, understood. In the meantime, I was reading in Barron's over the weekend, and they were talking about the competition in the space and actually noting that BYD has been taking market share and actually at 37 to the tune of about 37%, 4 times Tesla, leaving competitors like Li Auto, XPeng, and NIO in the dust. Where do we stand? Are we worried about the competitive space for Tesla? Because everybody always says what a leader Tesla is.
Look, the whole world's going electric. Tesla's the king of the hill. They just delivered 466,000 cars in Q2, $25 billion, on track to do 2 million cars this year, $100 billion in revenue. The Model Y is the best-selling car in the world, and they're about to launch the Cybertruck. So this is good news for them. But if you look at the big picture, Tesla, 21% of global EV auto share, BYD at 16.7%. But rounding out the top 5, 2 other Chinese companies, GAC at 6%, Volkswagen at 4.7%, and SAIC. So 3 of the top 5 selling EV brands globally are Chinese. There's a changing of the guard here.
Yeah. Take some water. There's so much going on. We had a great conversation with the chief financial officer of General Motors today. They're doing their push in EVs. There's concern about a strike by the UAW. They talked about how much inventory that they have to keep on hand in case of a strike. Where does that fit in for the Tesla picture? Could one man's problem be another man's win here? Where does that fit in here? And does Tesla have enough inventory?
I think Tesla will have inventory. Look, they've got 5 plants at full production now. They've just broken ground on another plant in Monterrey, Mexico. More coming. I think the big question when you step back and you look at BYD and say, wow, 352,000 cars they sold in Q2 to Tesla's 466. They're getting pretty close, but BYD is growing faster, 95% year over year. So keep an eye on the Chinese. The big question, if you step back and look at this, is will Americans and Europeans buy Chinese brands in general, but especially with IoT devices in every car? I think a lot of people are not going to feel comfortable with that. And the other big question is Tesla's lead in software that drops 99% profit margins to the bottom line going to outweigh China's big advantage in low-cost batteries? Those are the big questions. We'll see how it shakes out.
If the price is right, I don't care who you are and what your concerns are about China, there will be a willing consumer. But like Steve Wesley said earlier, the world is transitioning to EVs. Last I checked, there's still 90% of that market share left to be pulled out. The only numbers I truly worry about is whether or not Tesla is breaking records quarter over quarter in production and deliveries. If these things are happening, I don't give a f what the market share is.
Yeah, understood. At this point, what are some of the things that, when we think about Tesla, we think about AI, we think about batteries. When people, obviously the Cybertruck's coming, and I do want to talk about that, but what is Tesla, even software services? When you think about Tesla, what do you think is going to drive Tesla to the next, higher price point for shareholders? Because there's a lot of folks that are out there that think it's worth less than $100, and then you have those who are very positive on Tesla. Where do you think it's headed and why?
Look, I think it's going to go up. And what people need to understand is Tesla has 4 core advantages. One, they were one of the first to take battery production in-house. They have lower cost batteries than virtually anybody but the Chinese. Second, they've got an advantage, what's called over-the-air software. That gives them a big advantage. Third, they took their dealerships in-house. That gives them a big advantage over others years ago. And fourth, they've been a leader in the robotization of manufacturing. They will manufacture cars in a fraction of the time. They've got large stamping machines. They just have fewer parts in their vehicles. But if you step back a little bit and look to the not too distant future, Tesla's got this other huge advantage no one's talking about yet, but they will be soon. Tesla deployed 3.7 gigawatts of energy storage in Q2. That's enough to power all the homes in Chicago and Los Angeles. Their Megapack batteries combined with their AutoBiddo software enables them to provide turnkey solutions. In a nutshell, Tesla is quietly becoming a global utility. Now, Q2 energy revenues were only, I say only lightly, 1.5 billion, 6% of total revenue, but they're growing 222% a year. If they can keep up and expand their energy business for another year or two like this, their energy division may be their secret weapon.
What? In all seriousness, folks, this is why Tesla is so undervalued right now. My bear case has Tesla sitting at $364 per share, and that excludes everything but automotive. In my base and bull case, when I start adding those things in, the 1-year fair value estimate starts to get a little bit nutty. That's why I focus on the bear case, and from today, we still have a long way to go to even reach that. Worst case scenario, they only deliver 1.7 vehicles this year. Automotive margin drops to 15% for the year. These are the metrics that are in my bear case, and I'm still at $364 per share.
Stock's still in bear market territory. Joining us now is Oppenheimer analyst Colin Rush. He has a hold rating on Tesla. First, let's just talk about yesterday's move. Is it technical in nature? Was there some kind of fundamental basis for it, or just simply a stock that's been oversold that received a bit of a bounce on a little bit of good news?
I think it's more the latter than the other dynamics. I mean, the company is going through a bit of a product refresh here, and I think some of the discounting reports that were out there around pricing were oversold here, and I think people were digesting some of that. You know, you also see a stock move 20% like this one has, and a company that really is pioneering, you know, important technology over the coming decades, and I think folks, you know, just look at this and say, you know, time to take a short-term trade on this or cover a short.
Makes sense. So you have a hold rating. The stock's basically flat over the last year or so. What do you think would be the catalyst to the upside or downside from here?
You know, for us, it's really around a change in dynamics around the manufacturing margins and, you know, incremental evidence around the ability to monetize subscription services or recurring revenue, whether it's on the insurance side, on the self-driving technology. But the stock this year has moved, you know, in large part around the AI trade. And so what we're looking at on our end is that it's going to take a while for them to monetize some of that IP and the investments that they're making now. These are very complicated challenges. There's a variety of technologies that are getting pioneered right now, and as the company works through that, and we think they will be successful ultimately, there's going to be an investment cycle and you know, lower margins for longer, and that's why we're staying on the sidelines. And so as we look at this company, it looks like it's kind of in hibernation mode, or not necessarily hibernation mode, but in a flat line here for a little while as the company works through the real productization and monetization of the technology investments that they're making.
I agree with Colin. Despite this bump on Monday and early on Tuesday, which there is no explanation for, covering shorts sounds like a logical explanation, but there wasn't enough news to warrant that level of a jump. But Tesla is erratic and volatile.
On the, you know, the long-term side of things, you know, for capacity, you note in your latest note that this is a company that receives IRA benefits. They're investing heavily to expand that. What kind of time projection are you looking at on that front to see things really ramp up in terms of capacity?
You know, they are getting immediate benefit from those IRA provisions, so that's happening right now. I mean, the real core dynamic here around margins is the competitive dynamic, and you know, the competition out of Asia is getting very aggressive around pricing, and you know, the margins on the hardware here with the cars are going to be challenged for a little bit as the industry goes through a cost reduction effort to really break through and move into the mass market. That's not a short-term project. That's a multi-year project, and we think the company has, you know, a significant cost advantage versus a lot of their peers, particularly Western OEMs, and certainly has worked through a lot of the ramp challenges that a lot of those Western OEMs are working through right now. And this is just a multi-year process. And so as we look at this, waiting for the consumer to rebound a little bit, you know, rates to stabilize, and see that consistent sell-through and the ability to start raising prices or at least raising margins for the company, which we think, you know, probably happens over the next 12 to 24 months, but it's just not the next 3 to 6 months.
Buying and selling pressure is what motivates the stock market. Over the past couple of days, some pretty intense buying pressure. Covering shorts, maybe some hedge funds realize that the stock is an opportunity at this level. In conclusion, sweet words from GM CFO. No doubt they can talk the talk, but I need to know if they can walk the walk. Either way, no fucking bailouts. Nothing really new with Tesla except that they've gotten a bump in the stock price over the past couple of days. Don't get me wrong, there's plenty to like about it, but shouldn't all of that stuff be baked in anyway? And the real catalyst for Tesla to move higher should be whether or not they can get their production costs down and monetarily benefit from their massive software advantage. Well, that's all I got for you today. Be easy. Peace.